Welcome back. Let's invite Siddhartha Khemka on the show now to talk about the market setup on the last day of this year. And it's been a phenomenal year. Siddhartha, thank you very much for joining in. Well, the year belongs to PSUs. It's been a blowout performance. Most of them have doubled, tripled in this year. Which ones, if you had to name your top 3 PSU bets for 2024, which ones would they be?
Yeah, very good morning and thanks for having me on the show. So if you look at, yes, there has been a big run in the PSU, people who I should say public sector enterprises as a whole. And there have been several reasons for that. Clearly there has been an improvement in the business, in the financials, in the growth. And there's a lot of them have shown sustained improvement in the return ratios. One factor that that was the biggest missing link for the public sector enterprises, where the efficient use of capital was a big question always. But if you look across segments, that has improved a lot. Financials have improved, balance sheets have improved. So within those space, banking is one space which we continue to like a lot. We believe that what we had expected at the start of the year, that some of these PSU banks could start delivering on the 1% plus ROAs, that they have now delivered. And the leader among them, SBI, is something that we continue to like. We now expect that SBI could now, on a sustainable basis, improve the ROAs from 1% to 1.2%, and that should lead to the consistent re-rating. All the other matrices continues to remain strong. So that is one of our preferred picks within the public sector space. SBI, we have a target price of 800 from the current levels, which could gives a good, decent upside. The second stock is from the mining space, Coal India, which is our top pick for 2024 as well. We see robust volume growth and strong demand, which has been driving the power sector. So that will lead to the increasing volume for Coal India. E-auction continues to see some traction, where we expect the company to sell around 10% of volume, which would have a premium to the spot prices. And to top it all, Coal India has intensified its focus on capex over the last few years, basically to improve the evacuation infrastructure. This will only lead to higher production and more volumes. Valuations continues to remain very attractive. The stock also has a good dividend yield. So on a FY26 EV EBITDA, it is trading at 4.2 times. It offers an attractive dividend yield of more than 5%. So again, that's the second pick from the overall PSU space. Coal India, we have a target price of 430. Again, another 18-20% upside from current levels. And finally, another PSU stocks from the oil and gas space, which is GAIL India. We would have seen the report that came out today. Again, one of our top picks for 2024. We believe that the transmission volumes would be something that would drive the business for GAIL. Turnaround in petrochemicals is also leading to an improvement in ROEs. Another example where we said that PSUs are now sustainably basis showing an improvement in ROE. So we are expecting ROEs to improve from 9.5% in FY23 to about 15% in FY26. That's a huge, almost doubling of ROEs. So that is something that we like, and the company is also likely to report free cash flows of 45 billion rupees in FY26. So overall valuations is something which continues to remain comfortable. And with the improvement in volume growth, improvement in ROEs, we believe that re-rating for a stock like GAIL could be there. So we have a target price of 195 on GAIL.
Okay, all right. So lots of PSU picks there coming in. Siddhartha Khemka is still with us. Siddhartha, I guess you could perhaps listen into that conversation. And this is a hot topic, right? NBFCs and what lies ahead as we go through this phase of repricing of lines of credit. What's your sense on, I don't know if you track 5-star, if you do, then give us a specific take on this one. And in general, NBFCs in 2024, could this be a dark horse segment, or, would you be a little concerned and would you stay away, given that some of these margin issues will play out?
Yeah, hi Surabhi. So I think yes, it has been an interesting discussion, especially after the notifications from the RBI with regards to the non-secured or the unsecured lending, and the reaction to that has been pretty sharp from especially from certain segments of NBFCs. But what we see is that the repo rates have stabilized, and the narrative of interest rate cuts is now emerging, which should kind of help elevate the concerns regarding the NIM compression. And so overall, we have a positive stance on the NBFC sector. We expect that there could emerge some kind of margin expansion in the second half of 2024, and also led by some of the credit cost kind of coming down. Vehicle finances are something that are better placed than other segments, as we see the rates picking out and the margins bottoming out over the next 2 quarters. So, as I said, we are expecting margins to stabilize and then gradually expand as some of the existing books is replaced with the higher yielding new loans. So, asset quality continues to improve, and that is something that kind of gives some comfort. And as I said, we kind of like the vehicle financiers much better in this environment where auto sector has seen a strong growth, and that is leading to them being placed in a better situation. So M&M Finance is something that we like along with Siddhartha Transport Finance.
So that's a bit, I'm not asking you to really talk on the commentary there. We've got a big visionary speaking. But let's drill this down to, the market's hopes and expectations from both Reliance as a stock and, of course, the entire Tata Group as well. For RIL itself, given all that's happening on, across its various platforms, whether it's retail or digital or the core O2C business, what's your expectation from the Reliance stock in 2024?
Yeah, so I think Reliance, after the underperformance, should now take leadership. If the index has to move further from here, Reliance can no longer sit back and relax. And if you look at the concerns, especially for this year, has been the higher debt that they have been taking because of the newer investments and the newer businesses that they've got in. I think market will start already discounting that factor. So market will start looking at the core business, where again the core oil and the oil, petrochem and the chemical business that has started doing well. Crude oil prices have been stabilizing. We saw the margins, GRMs moving up, down, and everywhere. It should now be stabilized because we have seen a lot of changes, geopolitical issues globally as well. So overall, if you look at our Reliance Jio, the business growth has been pretty steady. Retail, again, something we saw across the board. Start of the year, things were not that good, but towards the end, the growth started coming back to the retail space, where Reliance Retail continues to do well. And the key that that the market will continue to watch is the standalone business, where the company has been able to deliver sustained performance. So we believe that segment-wise, the consumer business continues to do well with double-digit EBITDA growth, RGO, as well as Reliance Retail, likely to record a 15 and 30% CAGR over the next 2 years. And as I said, growth will be driven by retail sectors, footprint addition, new categories. So overall, we like Reliance. We believe that the company should do well now, with the core business also doing well. We currently have a target price of around 2,760. That's a decent upside. And as I said again, the stock should now start participating in the market with the underperformance having done by.